everyone! Welcome back to the channel. Today we're diving deep, literally, into a part of the oil industry that most investors ignore. Offshore drilling companies. We're talking about Tidewater, Valaris, and Borr Drilling, three stocks that have been quietly gaining strength. Are they undervalued? Are we looking at the next energy home runs? Let's break it down. Let's start with Tidewater, ticker TDW. Tidewater provides offshore support vessels for drilling operations. Basically, they're the logistics and lifeline for rigs out at sea. What's interesting, their stock has crushed the S&P 500 over the past 2 years. Why? Because offshore drilling is making a comeback, and Tidewater has the fleet, the contracts, and the scale to benefit. In 2023, their revenues grew over 40%, and their margins improved as rates per vessel soared. They've also cleaned up their balance sheet after years of pain in the energy sector. As of now, Tidewater trades at a forward PE under 10. That's cheap, especially for a company with growing earnings. Bottom line, Tidewater is a play on rising offshore activity, with strong fundamentals to back it up. Next up, Valaris, ticker VL. Valaris operates drilling rigs, both floating and jackup, across the globe. Think of them as the ones actually doing the drilling underwater. They went through bankruptcy in 2020, wiped out a ton of debt, and came back leaner and meaner. They've signed new contracts in Brazil, the Gulf of Mexico, and the Middle East, all high-demand regions. In their latest earnings call, they talked about rising day rates and strong forward demand. That means more cash flow in 2025 and 2026. Some investors worry about cyclicality. But if oil stays over $70 and demand from India-China grows, offshore drilling remains key. Valaris is more risky than TDW, but it has bigger upside if the offshore cycle really accelerates. And finally, a more speculative pick, Borr Drilling, ticker BOR. This is a smaller offshore driller focused on premium jackup rigs, which are in high demand for shallow water projects. They're still carrying a decent amount of debt, but the story here is leverage. If day rates rise, BOR's earnings could explode. They have one of the youngest fleets in the sector, and more rigs coming online this year. They recently secured contracts in Asia and West Africa, and their CEO is super bullish on 2025-2026 growth. It's a high-risk, high-reward play. Definitely not for the faint of heart. But if you're bullish on oil and want exposure to small-cap offshore drillers, BOR is worth watching. So what's the takeaway? TDW, safer. Infrastructure play with strong momentum. VL, direct exposure to offshore drilling rebound, solid growth. Some risk. BOR, speculative, but massive upside if the market favors them. Personally, I think the offshore cycle is just starting. These companies suffered for years, but now, with underinvestment in traditional oil and growing demand globally, they might be due for a major comeback. Of course, always do your own research and manage your risk. If you enjoyed this video, don't forget to like, subscribe, and comment which stock you'd pick, TDW, VL, or BOR. See you next time, and stay sharp in the markets.